Today on InvestTalk, we went over the latest scam that you need to protect yourself from. We answered questions on STRW, FDS, and UNP, and then we ended the day talking about nuclear power and the path moving forward for artificial intelligence.
This is InvestTalk, independent thinking, shared success.
Let's dive straight into our main focus point today, which is about a new AI voice cloning scam and how you need to protect yourself. Now, AI technology is rapidly advancing, which carries with it risks that we are not ready for. And so anytime these pop up, I think it's important for us to bring them to you so that you can, like I said, protect yourself. Let's dive right in to this new and I would say alarming type of scam that's catching people off guard using the latest in artificial intelligence, and it's known as voice cloning fraud. Now, it might sound like science fiction, something out of the movies, but the threat's very real. Starling Bank, a UK-based online lender, has raised the alarm that millions of people could soon fall victim to these sophisticated scams. So here's how it works. With just 3 seconds of audio, think of a voice clip you posted online or in a video or a message, fraudsters can clone your voice using AI tools. They can then use the cloned voice to contact your friends or contact your family and pose as you, often asking for sensitive information or asking for money. You can imagine how convincing this can be because it sounds like you on the other end of the phone. So Starling Bank did a survey. And in this recent survey, they showed some pretty concerning data. In the past year, more than a quarter of people surveyed said they were targeted by a voice cloning scam. But here's the kicker. 46% of people don't even know these scams exist. And 8% said they would send the money without hesitation, even if something seemed off. Now, what makes this especially tricky is how easy it is to gather audio needed to pull off these scams. Lisa Graham, Starling's chief information security officer, warned that many of us post voice recordings online without realizing we're making ourselves vulnerable. It could be, like I said, something as easy as a message to a friend on Facebook or some sort of Instagram video. Or even a podcast. Well, didn't think of that. Now I'm kind of scared. So what can we do about it? Well, Starling Bank is encouraging a simple yet effective solution, and that is agree on a safe phrase to share with your loved ones. Now, this is a random phrase, easy to remember, but hard for fraudsters to guess. Someone claiming to be you calls, they can ask for this phrase to verify your identity. But make sure not to share the phrase through text. If you do, delete the message after it's been read, trying to minimize the risk of it being intercepted by scammers. Now, with AI advancing rapidly, this threat isn't going away anytime soon. Earlier this year, OpenAI, the company behind ChatGPT, introduced a voice replication tool, but withheld its public access to avoid misuse like this. And they're right to be cautious. This technology, while exciting, also opens up new avenues for fraud and misinformation, and ways for people to take advantage of your loved ones, your friends. And so as AI continues to evolve, it's crucial to stay informed and take proactive measures to protect ourselves and our loved ones. Let's take a look at the market today. Certainly a timid end to an otherwise exciting week. U.S. equities are mostly lower, ending off a bit off of their best levels. The Dow was pretty flat, 9 basis points, up 9 basis points. S&P 500 down 19 basis points. The Nasdaq down 36 basis points. And small caps leading the charge downward. The Russell 2000 down 1.1%. And this comes after some pretty big Thursday gains yesterday that saw the Dow and the S&P close at new record highs. Today's underperformers included parcels and logistics, FedEx, a notable laggard today. Semis didn't do particularly well. Home builders, rail, chemicals, machinery didn't do well either. Relative outperformers included utilities. They've been pretty strong this year. Apparel companies, Nike doing well on the back of the news that their CEO is going to be stepping down. Tech hardware did really well. Communications and networking did well as well. Dollar index was up 10 basis points with the yen weakness the big story. Gold finished up 1.2% at fresh record levels. Crude oil ended down 20 basis points. And overall, as I said, it was a fairly quiet session, not a lot of news. Some focus on the softer industrial earnings numbers today that maybe drove the market down a little bit. But I think the big news was with FedEx missing and lowering their fiscal year 25 guidance on what seems to be still a soft industrial backdrop, cost pressures, and mixed headwinds on a macro scale. Nothing on the U.S. economic calendar today. Bulk of this week's data came, I would say, infirmer, underpinning the softer landing narrative. And when you look overseas, what you saw was the Bank of Japan leaving the policy unchanged, but that was no surprise. That was widely expected. Now, looking at the week, on the bullish side, the Fed kicked off its easing cycle with, I'd say, a more aggressive rate cut than some people expected a couple weeks ago, and a dot plot that showed a combined 200 basis points of easing for 2024 and 2025. The soft landing narrative certainly supported by the latest economic data. The Atlanta Fed GDP Now estimate for Q3 at 2.9%, which is largely in line with the above trend Q2 growth rate. Darden Restaurants, interesting information out of them, noted improvement in recent trends, which helped their stock rally despite its fiscal Q1 miss, maybe pointing towards some consumer resilience still. And comments from the Bank of Japan Governor Ueda on Friday tilted a little bit more dovish than some expected. On the bear side, there was some hawkish takeaways from Powell's press conference. He noted the market should not assume that 50 basis points of easing is the new norm. And also on top of all that, said that the neutral rate is likely significantly higher than it was pre-pandemic. FedEx, as I mentioned, missed on fiscal Q1 results and cut their earnings per share guidance for fiscal year 25. And Mercedes-Benz cut guidance as well, calling out the deteriorating economic conditions in China. Speaking of China August activity data came in softer than expected, and geopolitical tensions are still escalating in the Middle East and may introduce new global supply chain risks. Looking ahead to next week, the final trading week of the year, almost. There is a trading day of the year of September, a final full trading week of September, that is, given that Monday is the 30th. Next week brings new home sales and PCE on Friday at the end of the week.
Hi, guys. Love the show. I was just calling up about Union Pacific Corp, UMP, trying to find out if it's worth buying. I own a small position. I just wanted to hear what you guys think. Thank you.
So Union Pacific Corp, headquartered in Omaha, Nebraska, is a large cap company, got a $151 billion market cap, about $34 billion in debt. So not too much debt relative to the size of this company. Its interest coverage ratio, as of its most recent reporting period, about 7.5 times. So comfortable in terms of the leverage that it has. And what it does is it is a railroad and freight transportation services company. About a third of the revenue comes from industrial transportation, about a third comes from bulk, and a third comes from their premium segment. Now, they had a pretty good 2023. Looks like it rallied along with the broader market about 18% in 2023. And it is important to note that along with its debt, it has a pretty solid credit rating. I think most recently when I saw it was about an A- credit rating from S&P. So pretty stable outlook going forward. Now, with that being said, one issue that it has faced really over the past 5 years is growth. And it had about 23 billion in revenue in 2019, and that started to fall even before the pandemic. And certainly the pandemic was not good for this company. Revenue fell to about 19.5 billion. It's since recovered to about 24 billion, which is fine. But overall, over the past 5 years, what you've seen is relatively stable revenue, which means its annualized growth rate is about 1.1%. Now, taking that into sub-periods, what you do see, as I mentioned, is revenue declining and then revenue increasing. Certainly why it had a good 2023. And so far this year, it's flat, down 9 basis points. That's 0.09%. Over the past 3 months, it's up about 9%. So certainly it's had a better second half of the year than it has a first half of the year. And so the reason why a lot of people look at this name, unsurprisingly, given what kind of business it's not in a growthy business, is its dividend. It pays a 2.2% dividend. Its dividend over the past 5 years has kind of ranged between 1.9 and 2.4%, so pretty stable. In terms of its per share dividend, it's increased from $3.06 back in 2018 to about $5.20 last year, projected to be $5.25 this year. It's important to note that although the dividend has been on the rise. They also have bought back shares. They had 700 million outstanding back 5 years ago, now it's 600 million now. Cash flow looks exactly like their year-to-date price chart, pretty flat. I think overall, if you are putting this in a sleeve of your investment portfolio that's more focused on sustainable, sustained, consistent dividends, that's perfectly fine. But keep in mind, this isn't a big growing name. Not a lot to worry about. Again, their balance sheet looks completely fine. But overall, I think it's likely to trend and range where it is. It's currently trading at a price to book of about 9.2 times, exactly on where its 5-year average is. Same for price to earnings, same for price to cash flow. So there hasn't been a lot of growth over the past 5 years. They've certainly corrected the ship from a downward trajectory going into the pandemic. But I think the growth story here is likely to be what it has been over the past couple of years, and that's pretty flat. And so for growth, I would say no. For income, might fit for your portfolio. Thanks for the call. I hope you've been telling your friends and family members about our videos as well as our audio podcast. And over on our YouTube channel, InvestTalk with 2 T's, we like to take your questions when you leave them in the comment section. This question is about STRW. And the question is, do you think STRW is a good company worth buying? Now, STRW is Strawberry Fields REIT, and they are not a REIT that owns farms. They are instead a REIT that owns skilled nursing and healthcare related properties. Now, overall, they're a relatively young REIT. They're internally managed. They have gone through a very large acquisition strategy, taken on a fair bit of debt, but not too much debt. And overall, I think they're in an area of the REIT space that is probably going to be, I would say, more constant, especially moving forward, giving an aging population, giving the necessities of post-op care, medical care, all those things. That certainly that is good for them. Now, they have a market cap of $74 million, so they're incredibly small. They have debt of $538 million. So let's just say the better number is not bigger on that side. But overall, I think the big concern I have with this REIT, other than that it's very, very, very small, which means it has outside risks relative to the cost of financing, is they're primarily focused, I think, 80%, I believe, of their properties, somewhere around 80%, is one client. And so that means that if one administrator, their largest administrator of these properties, the largest tenant of these properties, goes bankrupt or something happens to them, well, it's likely to drag down this business as well. So, this is a situation where you have a very small company that has been growing. Certainly it has been growing. It's up 43% this year. It's up 78% on the 52-week period. But for me, within the REIT space, where you carry a lot of debt inherently, having such concentrated administrators of your properties is just too much risk for me. Now let's keep moving and pivot back to the InvestTalk voice bank.
Hey, it's Andrew from Atlanta. I was calling to get you guys to run down the following ticker symbol: F like Frank, D like David, S like Sam. FactSet Research Systems Incorporated had a great day on Thursday, and I'm just curious if you could take a look at this stock. Is this thing going up more? Something I need to hold? Should I try to buy? Should I trim? Please advise. Love the show. Have a great day.
Just take a look at it, FactSet. Again, if you watch our videos on our InvestTalk YouTube channel, you can see this puppy in action. This is exactly what I am looking at here. It is a research system that is used by wealth managers, by investment management firms, and it has a lot of data. It has pretty much all of the publicly available data on most companies, registered securities, even some information on private companies. And so they have had a decent past 3 months, up 14%, only up 10% in the past 52 weeks, actually down 2% year to date. But they've had some pretty solid growth. I know they've had some solid growth because we've seen the price of it increase, certainly. But over the past 5 years, look at that growth number, around 8-9% annualized basis. Now, in terms of their margins are expanding. In terms of their net margin, it was about 19.8% in 2018, projected to be 24.4% this year. And like many of the financial data tools, their margins are pretty big. In the mid 20s. Their gross margins are pretty high as well. They were in the high 60s back in 2018. They've fallen a little bit to about 54% this year, but still, the trend here is pretty solid. They recently had earnings, the price adjusted accordingly. Now, with that being said, they're a little overpriced in my opinion. I think they're a great company, but I think they're a little bit overvalued. They're trading about 10 times price to book value, 25 times price to cash flow, about 8.2 times price to sales. And it's important to know they do have a consensus hold rating right now. So I would say that there was a recent run-up related to earnings. It is a great business, but it is probably a little bit too rich to buy right now. Who agrees with me? A lot of the market, there's about 6% short interest out there right now. So I would keep my eye on it. Again, I think it is a very useful, a very important tool within the investment management industry. And I say all the time, if you want to invest within the financial services industry, look beyond the banks as well. Look at the backbone of financial services itself, and this is certainly one of them.
Here's a quick reminder. The newest InvestTalk Wealth webinar is happening soon, Tuesday, October 8th at 11 a.m. Pacific Time. The InvestTalk Wealth webinar will focus on effective strategies for managing your 401k and enhancing your retirement savings. Go to investtalk.com and sign up for our upcoming Wealth webinar, October 8th. It's free to attend, but you must pre-register. And please tell your friends.
Hi, good day, Justin and Luke. A long-time listener to the show here from Minnesota. I have a question. A few weeks ago, one of you gentlemen, I believe, said having some gold in a portfolio would be a good thing. I've been doing some research and I found the fund GLD. I have a question. What do you think about that? Would it be a thumbs up? And I also did research, and does it contain some other minerals besides gold? And does it also pay a dividend? You just let me know those things, and if you think that'd be a good move, I'd appreciate it. Thank you very much. Have a great day.
So ticker GLD, SPDR Gold Shares ETF, actually invests directly into physical gold. And what it tries to do is it kind of tries to reduce the difficulties of buying, storing, and insuring the physical products. And so generally, you would expect then the price and return of this fund to nearly perfectly mimic gold. Now, it does this to the tune of about 40 basis points. So, for a commodities ETF, it's fairly priced. Now, with that being said, certainly gold has been on a historic run. And gold within your portfolio offers many benefits. And one of those benefits is diversification. You have assets that are, what you want to do within portfolios is include assets that are not perfectly correlated. And so if you believe that the US government and global governments will continue to issue a lot of debt, the currency will be devalued, then gold is certainly a good investment. And whereas a lot of gold exposed ETFs are investing in gold miners or gold companies, it's interesting to me that this fund is actually taking physical delivery of this gold. So overall, I like it. $72 billion assets under management, 40 basis point expense ratio, ticker GLD. Now on Fridays, we like to make the time for a quick rundown of key benchmark numbers. So let me hit you with a list of those now. The 2-year treasury yield was at 3.597% today for perspective. Last week, that number was 3.576. 7 weeks back, it was 3.882. 45 weeks ago, it was at 5.05%. And 143 weeks ago, that was at 64 basis points. The 10-year treasury yield was at 3.741% today. Last week, it was at 3.646. 3 weeks ago, it was at 3.921%. 45 weeks back, it was at 4.63%. And 139 weeks ago, it was at 1.762. Gold, we just talked about it, reached another all-time high today, $2,622 per ounce. Last week, that number was $2,583. 45 weeks back, less than a year ago, it was $1,935. And 133 weeks ago, it was $1,806. Silver today was priced at $31.17 per ounce. Last week, that number was $30.65. 31 weeks ago, it was $22.80. And 126 weeks ago, it was $23.94. Oil, another commodity, was selling for $71.77 per barrel today. Last week, that number was $68.65. 41 weeks ago, it was $74.30. And 141 weeks ago, it was $66.62. National average for a gallon of regular gasoline is $3.22 per gallon, a 1 cent decrease, and every cent helps from last week's number. 68 weeks ago, it was $3.56 per gallon. 116 weeks ago, it was $4.25. And 136 weeks ago, it was $3.57. In California, gas was averaging $4.75 per gallon. That is a 1 cent increase. We're heading the wrong way from last week. 47 weeks ago, that was $5.32, and 123 weeks back, that was $5.87. For comparison, in North Carolina today, gas was averaging $2.91 per gallon. That is $1.84 less per gallon than gas in California. Now, as we like to do on Fridays as well, I want to give you information on the latest KPP Premium newsletter. Now, the KPP Premium newsletter, should you be a subscriber, will hit your inbox every Saturday afternoon. In the KPP Insights section, we are talking about the yield curve, all the information you'd ever want to know, and I guess not want to know, probably more than you want to know about the yield curve. What is it? What is it a good measurement of? How does it move? In our stock ideas section, we talk about a vehicle manufacturing company and a payments company. And in the portfolio management section, we talk about signals that historically have come from the yield curve and how that might tell you to adjust your portfolio. If any of that sounds interesting to you, if all of that sounds interesting to you, if even one part of that sounds interesting to you and you would like to know more, head over to investtalk.com and sign up for our KPP Premium newsletter, a reminder that will hit your inboxes Saturday afternoon. Now let's shift gears back to an interesting, let's say, development in that the Fed cut rates more than a lot of people expected. For the past year, investors have enjoyed the stability of a 5% yield on short-term U.S. debt, and it was one of the safest places to park cash. But the landscape is changing, and that's because of that decrease in the benchmark rate by the Fed. And on top of that, given what the dot plot says, more cuts are expected in the coming years. And so this shift is making waves in the market. So where might investors think about moving their money? Well, 5 different experts weighed in. Saira Malik from Nuveen, which manages over $1 trillion, expects the economy to slip into the economy to have slipped into a recession by now. But inflation has cooled. The job market has only recently started to weaken. And so the belief for Nuveen now is that it may take time for a recession to hit and that stocks could remain strong for the next year. Now, with the Fed cutting rates, cash yields will soon drop, pushing money back into the market. So Malik is eyeing opportunities in fixed income investments like municipal bonds and high-quality companies that can survive a downturn. Rob Arnett, founder of Research Affiliates, is more cautious. He worries that the Fed has raised rates too far and held them high for too long. And what that does is it increases the risks of a hard landing for the U.S. economy. And so Arnott advises looking for value investments, especially outside the United States, where markets may be better positioned for growth after their own more prolonged slowdowns. Richard Bernstein of Richard Bernstein Advisors says the current market has been driven by speculation in a few major tech stocks, but he's more optimistic about small and mid-sized companies. With the Fed's shifting policy from raising to cutting rates, he expects capital to flow towards more cyclical sectors like manufacturing and finance, which could benefit from the changing environment. At Northern Trust Wealth Management, Chief Investment Officer Katie Nixon has seen clients flock to cash as a safe haven. But Nixon warns that rate cuts could bring more volatility to equities. She suggests focusing on sectors like healthcare and pharmaceuticals for steady returns, while also keeping an eye on capital-intensive investments like real estate and infrastructure that benefit from lowered borrowing costs. And finally, Jack Ablin from Crescent has been riding the wave of AI stocks, but he's also been investing in private credit, earning impressive yields from floating rate loans. With falling rates on the horizon, Ablin expects a shift in capital from big tech stocks towards smaller companies that are more sensitive to borrowing costs. He also sees opportunities in markets, particularly in Japan, where a weak yen could provide a dual boost of rising stocks and currency gains. And so now I gave you a lot of information. And the point of all this is to say that there are many different ideas about where the market is headed based upon where it's been and what we know will happen over the next 6 months to a year. Now, for us, we generally think that equities will continue to rise, but probably enter a more choppy period of volatility. Why? Well, mentioned it at the top of the show. You have political instability on the rise in the Middle East, an area of the world that historically has been less than stable. And all of this political instability could lead to maybe a resurgence of inflation through damaged supply chains. But either way, generally what we see for now, and things can rapidly change, things do tend to change very quickly, but the path of least resistance still seems for the next 6 months to a year to be a general trend higher. And I agree with some of what these people have said. I do think that a lot of the market appreciation over the past 2 years has been related to a small basket of tech stocks. And that can be a good thing and a bad thing, right? That could mean that, well, the market may be at a higher level when you look at specific indices overvalued. But if that's related to a small basket of securities, there's still a lot more growth out there. So for us, for the next 6 months, we're looking for value-oriented securities that can survive downturns. We're looking for securities that are not overly priced, that have not had significant run-ups over the past 2 years, that are stable businesses, that do well as one would expect them to do in a rotation out of tech and into those names that historically do well coming into rate-cutting cycles.
I was wondering for moving averages, which time frames you guys like to use, whether it's the 50-day, 100, or the 200. Thank you.
You know, generally speaking, Justin is more of the technical analysis guy than I am. On a high level, what you'd want to look at is a combination of all of them. You'd want to know how securities are moving relative to 50-day moving averages, more medium-term moving averages, and long-term moving averages. And the reason for that is because you shouldn't let your trading strategy, right? I don't think you can use technical analysis as an investment strategy alone, but it certainly can be helpful in your trading strategy. You want to look at different time frames to discern different trends because they each tell you something. What I tend to look at is price momentum, which is just another way to look at technical factors. And so I'm looking at price momentum relative to sectors or relative to the overall market on a 1-month basis, on a 6-month basis, on a 12-month basis, on a 2-month basis, all sorts of different time frames because each of them have a place in your decision-making process. So to answer that question that you asked, 50, 100-day, 200-day moving average, all of them. Thanks for the call. Now let's play another caller question from 888-99-CHART.
I was calling in regards to ticker symbol RIO, Rio Tinto. I was wondering what you guys thought about entering Rio Tinto, or exiting, I'm sorry. I actually own 100 shares of it and was wondering, should I buy more? So just wanted to know what you guys thought about it. Thank you, and keep up the good work.
So Rio Tinto is a mining company, and 57% of its revenue comes from iron, about 22% from aluminum, and 12% from copper. As you'd expect, given where these mineral prices have been over the past couple months, they haven't done particularly well, though they're only down 5% in the past 3 months. Probably not down as much in the three-month time frame as a lot of these mining companies. In terms of the relative valuation, it's pretty cheap, trading at 1.9 times its book value, below its 5-year average. Trading at 6.8 times on its cash flow. And so when you look over the past 5 years, what you see is pretty solid growth, about 6% on an annualized basis dating back to December 2018. Now, they're supposed to fall off a little bit in terms of revenue this year, but again, that's to be expected when you are running a business where the revenue is predicated upon the underlying price of the commodities. Now, one issue with this company is that they're being investigated for a lot of things. They're being investigated for destruction of sacred areas in various countries. They're being investigated for or maybe they already have been, there's already been a ruling in it, but there was a bribery scandal in 2023. There's been workplace culture scandals. So it's a company that does come with a lot of baggage. And so I think there are better miners out there to be invested in. I actually kind of like this mix a little bit in terms of where it derives its revenue. But again, there's a lot of baggage here that has been weighing its price down even before you had the fall in commodity prices. So to answer your question, would I sell Rio Tinto? only because I think there are better miners out there. But given where commodity prices have moved, now is actually a pretty decent time to start investing in miners. So I think generally speaking, the outlook for miners is good over the next year, 2 years, and that's because of where commodity prices are now. But I just think this company carries a lot of baggage, and there's a lot of better miners out there to be invested in. Thanks for the call. Now, I'm not sure if you've heard, but there's been a major move in the energy sector, and it's linked to the booming world of artificial intelligence. Now, today, news was released that Microsoft has just inked a deal with Constellation Energy to restart the undamaged reactor in Pennsylvania's 3 Mile Island, a site once infamous for the country's worst nuclear disaster back in 1979, I believe it was. Now, under the agreement, Constellation will spend around $1.6 billion to revive the dormant reactor, which was closed in 2019 due to operational costs. Microsoft, in turn, will secure clean, round-the-clock energy for its data centers to power its AI ambitions. Now, these data centers are very energy hungry, and Microsoft is looking for reliable but also carbon-free electricity sources to meet its sustainability goals. The deal is pretty important. It's pretty groundbreaking, not only because of the iconic location, but because it signals just how crucial energy is becoming for the tech sector, especially artificial intelligence. Data centers need huge amounts of electricity. And as renewable energy sources like solar and wind remain intermittent and sometimes unreliable, tech giants are increasingly turning to nuclear power to ensure a stable baseline energy supply. Now, Joe Dominguez, the CEO of Constellation, calls this the most important energy commodity in the world, highlighting how difficult it is to replicate clean but also consistent energy. The deal also fits into the broader trend of nuclear energy's resurgence in the United States. And so new federal tax credits, along with substantial state and federal funding, are making nuclear a viable option again, as seen with similar efforts to restart reactors in Michigan and now potentially Iowa as well. Now, it's important to note the restart, it won't happen overnight. The reactor will require federal safety and environmental reviews, a whole lot of regulatory red tape, necessarily so, before it can operate again by what they estimate is about 2028. But once up and running, the plant will generate 835 megawatts of power, enough to support more than 600,000 homes. And so it's not just 3 Mile Island. Dominguez hinted that Constellation could add as much as 2,000 megawatts of nuclear power in the coming years. It's about the same output as a plant in Georgia, which was the first new nuclear project in the US in years. So what does this mean for us? What does this mean for investors? Well, shares of Constellation certainly jumped. They jumped more than 15% on the news, showing that the market is reacting positively to this nuclear revival. But it also is a continuation of a trend that we've seen. As energy demand continues to rise, particularly from tech giants like Microsoft, investors may want to watch the nuclear space closely. And it's had a good run-up, but it looks like, especially given this news, there's still more room to run. Before we head off, I want to answer one quick question. This one on a name that we get often, ticker CIVI. It says, could you take a look at CIVI? You guys gave it a thumbs up a while back, and since then, it's dropped 15%. I was looking to pick some up. Let me know your thoughts. CIVI is an oil company. It's an integrated oil company. And they have about $4.8 billion in debt on a $5.3 billion market cap company, but their interest coverage ratio is around 3.44 times, so it's not overly levered, even though they do have a significant amount of debt. And so 80% of their business is oil. 80% of their business. Past 3 months, they're down 19%. Why? Price of oil has fallen precipitously. It's down to $71 a barrel as of today. And so, again, I try and stress this often. This is a company whose cash flow has been improving over the past 5 years. This is a company whose profitability has been pretty steady as well over the past couple years. Certainly it boomed in 2022, but it's directly tied to the underlying commodity. So when you see a company's price falling, it can be an idiosyncratic thing. It could be specific business risk. It could be a poorly run company, or it could just be that the main source of the revenue, the products that this company sells, the price is just falling as well. So as demand for oil has fallen, you've seen this broadly across the board. oil companies have fallen too. But for me, when the price of oil is this low, I consider it a buy. I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. You can get yours anytime at iTunes, Google Play, and Spotify. Please be sure to rate and review us on iTunes. Now, I hope you've heard that the InvestTalk podcast is also available in video form on our YouTube channel. Just search InvestTalk, and remember that's InvestTalk with 2 T's. Please also tell your friends and family about our upcoming wealth webinar on October 8th. As a reminder, it will focus on effective strategies for managing your 401k and enhancing your retirement savings. Independent thinking, shared success. This is InvestTalk. Enjoy your weekend.